Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. Sorry I missed yesterday's show, I was busy. Today is Thursday, July 18th, 2024, and today's episode, markets are getting bearish, and daily reminder, 2-year, 10-year yield curve inversion is past its second birthday still. Also, notably, next week we have GDP on Thursday and PCE on Friday. As mentioned in the other screen, the S&P 500 SPX was looking not bullish anymore as of yesterday, and definitely looking a lot more bearish today. Pretty large red candle. This is no longer bullish looking, however you want to look at it. Taking a look at a weekly time frame as well. We had pretty solid moves up. Granted, the week's not over till tomorrow, Friday. Might change the look of this thing, but these candles do matter on a weekly time frame, and this could, it engulfs the previous week, at least today on Thursday. We'll see again what happens on Friday. But it's looking like we really could turn over here, at least for the next few weeks, by what it looks like at this point. I wanted to mention the VIX futures curve. I had been noting since 3 or 4 months ago how I found it odd to see a spike in October and then it settling down after, and nothing's changed. I think it's really just a seasonality. It seems like the market is expecting it's interesting, right? We have 93% chance of a cut in September, which in a way is bullish for markets, but the VIX futures curve is showing a large spike in October, settling down afterwards a little bit. Speaking of the VIX, I had noted 2 days ago how we had broken out of this wedge pattern here, and I was able to take pretty good advantage. I bought some calls on UVXY as well as calls on SOXS. Both, they both go up basically when things are getting more volatile and things are going down, and that's been pretty, that has played out well for me so far. As you can see, we've had a pretty major spike up in the VIX. Gareth Solway on his show expects it to go up to 20, he says. He thinks this spike is headed up there, so we'll see how that plays out. I'm still holding my basically shorting the market positions. Notably, we were, getting into greed mode pretty recently, especially on small caps, a little bit of broadening, and today we went back into neutral. Wanted to bring up the U.S. Treasuries yield curve. I noticed on Steve Van Meter's show, I watch his show sometimes, he had been noting how we recently got to the point where the 5-year and 10-year uninverted, and the whole point here is that, if the short end drops below the long end, that typically is like, okay, yeah, we're headed into a recession. If this end rises up above this end, if the long end rises above the short end, that's the Goldilocks scenario. That means the market trusts that it can handle higher rates, and higher rates are deserved, and that's not happening. So what happens is that when we start to uninvert the other way and the shorter end drops, you'll see the 5-year first drop below the 7-year, which it has already done, and eventually you'll get the 3-year dropping below the 5-year, 2-year below the 3-year, and so on. And we have been headed in that direction pretty recently, and that's been a notable development over the last week or two. I wanted to bring up TYX Treasury yield on the 30-year note. I had mentioned 2 days ago how we had broken sort of a short-term trend line, how it looked like it might want to go down, and it did. It confirmed that breakdown there, and by charting standards, we broke back above it today, but you know, in order for the line to hold above it now, we actually need to see a close above the top wick of today's candle in the 30-year Treasury yield. I'm expecting this to go down. Obviously, as I've said, I'm pretty highly exposed to this. I wanted to bring up uranium just because I found a notable thing happening. Basically, pretty easy to see. We've recently gotten to basically a all-time high in the uranium market since really 2011, and upsloping trend line, head and shoulders. We had a breakthrough of that today through this trend line, and so uranium looks fairly bearish. Again, I see this as a welcome opportunity to perhaps buy more, as in, longer term. I think uranium is a great thing to be invested in for lots of different reasons. But just my opinion there. SMH, Gareth Holloway on his show had noted, well, I think it was on the triple Qs. No, I guess it was SMH. He said that this pattern formation here, including this red candle here, followed by another engulfing red candle here, is the equivalent of seeing a white whale. He said he's never seen something so bearish looking in his entire trading career. And so me and my crystal ball decided to, off of that news, get some calls on SOXS, an inverse triple leveraged fund of SMH. This is, of course, semiconductors, and it has been playing out pretty darn well to my favor so far. I expect this to go down. I'm likely I'm up pretty heavily on the position at the moment. I do expect this to go down lower. I think I'm going to chicken out and sell it out tomorrow no matter what happens. But anyway, main thing here is I've been talking for a while about how I think that semiconductors as a whole has just been getting unbelievably overvalued. It's really similar to railroads in the late 1920s, dot-com bubble. It can't just be worth an infinite amount of money. It's similar to silver as well. I had two major squeezes. The most recent one in 2011, where anything that had anything to do with silver was getting a huge bid. All of the little tiny companies that said, hey, we own land that has silver mines underneath it that we don't have any plans to mine, the value of those companies had gone to the absolute moon. And right now we're experiencing that with AI and semi-chips. The PE ratios have gotten way out of hand, including with the mega caps, which is, it's reminiscent of what really happened in 1929 with the railroads, getting over leveraged. Everybody and their neighbor was leveraging up on these things, and it didn't play out so well in the end. I mean, think of it, railroads back in 1929, they seemed like they were going to expand forever. Look how big the United States was. Look how amazing trains had changed life for everyone. It was humongous development, but the overexcitement about railroads turned into a depression that lasted a long time, and investors were not made whole for several decades. We could be seeing a similar thing playing out right now with semiconductors and artificial intelligence, in my estimation. Last chart I wanted to mention of the day, triple Qs, the NASDAQ. Very similar looking chart to SMH. Not white whale-ish looking as much as the SMH, but plenty bearish, and looks like it wants to go lower, at least for a little while. That's all I have for you for today's show. Hope you enjoyed. Thank you for watching Robschild.